All right, let's jump right into this explainer. We're going to completely demystify a pretty fascinating, if slightly dense piece of financial literature, the scheme information document for the Groww Nifty Smallcap 250 Momentum Quality 100 Index Fund. Now, if you've ever found yourself wondering how these mutual funds actually operate beneath the surface, well, you and I are in the exact same boat. We're going to break down this highly detailed source text together and give you a crystal clear understanding of its internal mechanics.
So what exactly is hiding inside a 40-page mutual fund document? It's a great question, right? When you first open up one of these massive regulatory filings, it can feel like you've stepped into a labyrinth of compliance clauses and heavy legal terminology. But don't worry, rather than drowning in all that financial jargon, we are going to unpack the core objective, the underlying strategy, the specific risks, and the actual real-world costs of this fund, step by step. By the time we wrap up, you're going to know exactly what powers this investment vehicle.
Right off the bat, this document sets a very specific baseline for us. An index fund is a passively managed scheme that invests in securities to mirror a specific underlying index, aiming to match its returns before expenses. So what does that actually mean for us? It means the fund is entirely passive. There isn't some hotshot fund manager sitting at a desk trying to outsmart the market or pick the next winning stock. Nope. Instead, this fund has one very specific mandate: to blindly and faithfully replicate the Nifty Smallcap 250 Momentum Quality 100 Total Return Index. It literally buys the same stocks, in the exact same proportions, and its only goal is simply to match the benchmark's performance.
Section 1. The Engine. The Asset Allocation Strategy. When you break down where the money actually goes, you'll see a massive 95 to 100% of the fund's capital is mandated to go directly into the equity constituents of that specific small cap index. It's essentially the whole shebang. But you'll also notice a tiny sliver, ranging from 0 to 5%, that's reserved for debt and money market instruments. Now, the document is clear. This little buffer is not there to generate massive yields. Actually, it's just for practical cash management. It's there to ensure the fund has daily liquidity, just to handle routine things like investor redemptions. Keeping that passive strategy running smoothly behind the scenes actually requires some pretty strict operational mechanics. The source document dictates that whenever the underlying index changes its constituents, say dropping one company and adding another, the fund has to rebalance its portfolio within 7 calendar days. On top of that, it's permitted to hold up to 20% exposure in equity derivatives. And crucially, this isn't for wild speculation. The document explicitly allows it for non-hedging purposes, primarily to maintain tight index replication. Basically, they use derivatives when buying the physical shares might be temporarily difficult or just inefficient. Trades are, of course, executed via standard mutual fund trading platforms. And all of that daily activity, it gets boiled down to one single metric at the end of the day: the net asset value, or NAV. The document actually provides the precise formula they use for this daily computation. Sure, it might look a bit like a high school algebra test, but it's fundamentally just taking the market value of the scheme's investments, adding current assets like accrued income, subtracting current liabilities and accrued expenses, and then dividing that whole thing by the total number of outstanding units. It essentially proves that absolutely every single expense, liability, and asset is mathematically perfectly balanced every single day. Section 2. The Reality Check. Decoding the Very High Risk.
Now, according to the official document, the internal assessment places this specific small-cap index fund squarely in the very high-risk category. That riskometer needle is pinned all the way into the red zone. And listen, this isn't some clever marketing gimmick. It's a mandatory regulatory disclosure. It's explicitly warning investors that the potential for significant volatility isn't a bug. It is absolutely a built-in feature of this fund. The document impartially outlines these core risks, explaining exactly why that needle is pointing so hard to the red. First up, because it's an index fund, it carries general market risk and volatility. If the broader Indian equity market drops, well, the fund drops right along with it. There's no active manager to pull you out of a dive. Then, more specifically, it highlights liquidity risk. Small-cap securities inherently have restricted trading volumes, meaning it might be tough for the fund to buy or sell large blocks of shares quickly. We also have tracking error risk, where the fund returns might deviate from the benchmark. And finally, concentration risk, because the fund is forced to mirror the exact volatility and stock concentration of the underlying index, for better or for worse. Section 3. The Fine Print. Costs and Tracking Errors.
0.90%. According to the document, the maximum base expense ratio is hard capped at 0.90% of the daily net assets. Basically, this is the absolute ceiling for what the asset management company can charge you to run this fund. And this single number has to cover a multitude of operational necessities. We're talking investment management fees, audit fees, custodian fees, marketing, and even the costs of generating your account statements.
And here is a really specific, fascinating detail you should absolutely take away from this explainer. The AMC will annually set apart 0.01% on daily net assets specifically for investor education and awareness initiatives. It's a very tiny slice of that expense ratio, sure, but it is strictly mandated. It ensures that a guaranteed portion of those fees goes directly back into promoting financial literacy for everyday investors.
Section 4. The investment mechanics, minimums, loads, and errors. 500 rupees. That's the baseline number you really need to know here. The document establishes 500 rupees as the absolute minimum application amount for lump sum investments, switch-ins from other funds, and standard withdrawals. It's clearly designed to be a highly accessible entry point for a really wide range of investors who are looking to gain exposure to this small-cap index.
0%. That is the stated exit load. So what does that mean in plain English? It means the fund itself does not charge you a penalty fee if you decide to redeem your units and take your money out. You've got complete flexibility to exit the investment without any financial friction cost being imposed by the asset management company.
Now this next number is a critical metric to understand. 2%. This represents the maximum expected annualized tracking error under normal circumstances. Remember how we said an index fund tries to copy its benchmark perfectly? Well, reality often gets in the way. Things like cash drag, transaction costs, and corporate actions cause a slight inevitable mathematical drift between the fund's actual performance and the theoretical index. The document is totally transparent here, stating they aim to keep this drift, or tracking error, below 2%.
When you actually decide to enter the fund, the document outlines a bit of a fork in the road. You have option A, the regular plan, and option B, the direct plan. The regular plan means you're investing through a mutual fund distributor or broker, so those distribution expenses are baked right into the fund's costs, which generally means a higher expense ratio. The direct plan, on the other hand, means you invest directly with the AMC. This bypasses those distribution commissions entirely, which generally results in no distribution expenses and slightly higher compounding returns for you over time.
You're also going to face a second choice regarding how your actual earnings are handled. You can select the growth option, where your returns are silently reinvested back into the fund to just compound over time. Or the document details the IDCW option, which stands for Income Distribution cum Capital Withdrawal. This option allows the fund to periodically pay out or sweep portions of that capital and income back to you. It acts a bit more like a dividend payout system, depending entirely on what your personal cash flow needs are.
Now let's see how these minimums build into automated investing. If you prefer systematic investment plans, or SIPs, over one-time lump sums, the document provides an exact matrix for that. You could automate your investments on a daily or weekly frequency for a minimum amount of just 100 rupees. The daily option requires a minimum of 180 days, while weekly requires 24 installments. Or you could step it up to a monthly or quarterly schedule, which requires a minimum amount of 500 rupees. Monthly needs 12 installments, and quarterly just requires 4 installments to lock in that investing habit.
Before we wrap up, I absolutely have to highlight this stark warning pulled directly from the risk factors section of the document. Quote, derivative products are leveraged instruments and can provide disproportionate gains as well as disproportionate losses. No assurance can be given that the fund manager will be able to identify or execute such strategies. End quote. It's a vital reminder. While the fund uses derivatives to maintain its index alignment, those highly technical instruments carry their own very complex, very unpredictable risks.
So, does your personal risk appetite truly align with the mechanical, passive, and volatile reality of a very high-risk index fund? Ultimately, after unpacking the stark anatomy of the specific scheme information document, seeing its rigid passive engine, the cost structures, and that glaring red riskometer, the most important question isn't really about the fund itself. The real question is whether this mechanical, volatile financial vehicle actually matches your own personal investment journey. It is absolutely a lot to chew on, but having the facts straight from the source, well, that's always the best place to start.